Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Today, we're going to be covering 6 credit accounts that can help you build wealth faster. And if you're not familiar with these accounts, I recommend you start learning more about them after today. Most people are taught to look at credit as a way to buy things they can't afford and pay them off later. However, wealthy people frequently use credit in an entirely different way. And instead of using credit to purchase liabilities, they will use it to acquire assets, to increase income, to expand businesses, to purchase real estate, and create opportunities that may have taken years to fund using cash alone. I wish that someone would have explained this distinction to me earlier, because for years, I thought the entire goal was simply to get a good credit score, to qualify for a few high-limit credit cards, and just avoid being denied. I didn't fully understand that a strong credit profile could eventually give you access to capital that could completely change the trajectory of your business and your investments. A high credit score by itself, it may not make you wealthy. However, a strong credit profile combined with income, discipline, knowledge, and the right opportunities can give you access to financial tools that most people never learn how to use. So without further ado, let's get right into the video. Let's start with an easy one that everybody is familiar with. That's going to be 0% APR business credit cards. While everyone does know what this is, I think this is still one of the most misunderstood financial tools in business. Most people see a credit card as a convenient way to spend money, and a business owner should look at a credit card as a potential source of short-term working capital. Depending on the offer, a business credit card may provide an introductory period during which interest is not charged on eligible purchases. That introductory period gives the business owner time to deploy the capital, to generate revenue, and repay the balance before the promotional period expires. Imagine that you have a profitable product, but you consistently run out of inventory. You know that every $10,000 you spend purchasing additional inventory has historically produced $18,000 or $20,000 in sales. However, you don't have enough cash available to place larger orders. A 0% business credit card could potentially allow you to purchase the inventory today, to sell it over the following months, and then repay the card by using the revenue that you generated from those sales. The only thing you have to keep in mind is that you need to have a repayment plan before you make that purchase. The 0% APR period will eventually end, and once that happens, the account will begin charging a much higher interest rate on that remaining balance. If you're interested in learning how to use 0% APR business credit cards to generate income, or to fund new opportunities, or to scale your business, check out my business credit playlist. I have hours of content walking you through this process, from preparing your credit profile to applying for funding and using capital strategically. You do have to keep in mind that most business credit products will require a personal guarantee, which would mean your personal credit will play a major role in whether or not you get approved. And if your current credit profile is not strong enough to qualify, well, that is where Rising can help. Rising is an all-in-one credit repair platform that gives you access to your credit reports and your scores. It also shows you what may be hurting your credit, and it helps you take action with tools like dispute templates, bureau response tracking, and using the auto mail feature to mail your disputes from the website or the mobile app. You should use Rising as your 90-day credit improvement system. It also includes up to 24 months of rental and utility trade lines that can back report payment history, and that can help add positive on-time payments up to 2 years of account age to your credit profile instantly. It's also very easy to get started. Once you sign up, watch the How to Use Rising tutorial video that walks you through the platform in about 7 minutes or less. Right now, you can access your credit report through Rising's $1 7-day trial. You can check it out in the link in the description. You can also use this clickable link that will be here on screen. Never forget that the real power of 0% APR business credit cards is not the rewards, it's not the sign-up bonus, and it's not the status that comes from having a premium card. The real power is having access to low-cost capital that you can direct towards a profitable opportunity. The second account is a home equity line of credit, commonly referred to as a HELOC. A home equity line of credit allows a qualified homeowner to borrow against a portion of the equity that they have built in their property. Equity is generally the difference between the current value of the home and the amount that you still owe on the mortgage. If your home is worth $500,000 and you owe $300,000, you'll have $200,000 in equity. Now, that doesn't necessarily mean that that a lender will allow you to borrow the entire $200,000, but a portion of that equity, usually around 75%, it can be turned into a line of credit. That means you can borrow money when needed, you can repay it, and borrow from the available line again during the account's draw period. This flexibility can make a HELOC useful for real estate investments, for business opportunities, or substantial expenses. For example, a homeowner might want to use a HELOC to renovate a property in a way that will increase its rental income or market value. Someone else may use a HELOC to help purchase an investment property, or a business owner might want to use a portion of the credit line to fund expansion, maybe acquire equipment, or take advantage of an opportunity that requires capital very quickly. The potential benefit is that home secured financing may offer more favorable terms than unsecured debt because the lender has collateral. However, that collateral is also what makes this account dangerous. Your home secures the debt. If the investment fails, you're still responsible for the balance. Failure to repay the account could ultimately place your home at risk. So the way that I see it, the potential upside should justify that level of risk. You should also understand that many HELOCs have variable interest rates. So that means the cost of borrowing can change over time. You need to understand the difference between the draw period and the repayment period. During the draw period, you may be allowed to borrow from the line, and depending on the account, you can make payments based primarily on the interest or outstanding balance. Once the repayment period begins, you may no longer be able to borrow additional funds, and your required monthly payment could increase. Before using a HELOC, you should calculate the worst case scenario. And for a deeper breakdown, watch my video titled "Turn Your Biggest Expense into Your Fastest Path to Wealth," because in that video, I explain several ways that you're able to potentially use a HELOC to generate income and build wealth. I'm going to link that video right here. The third account is a securities-backed line of credit, sometimes referred to as an SBLOC or a portfolio line of credit. Now, this type of account is generally designed for investors who have eligible assets inside of a brokerage account or some type of investment account. So instead of you selling those investments to raise cash, the investor can pledge a portion of the portfolio as collateral, and they can borrow against its value. That can provide access to liquidity without immediately selling the underlying investment. For example, imagine someone has $500,000 invested into a diversified portfolio, and they need $75,000 for a business opportunity or a real estate purchase. Now, one option is to sell $75,000 worth of investments. However, selling may create taxable gains, it could interrupt your long-term investment strategy, and it removes those assets from the market. A securities-backed line of credit may provide another option. So you, as the investor, you can borrow $75,000 while keeping the investment inside the account. So that would allow the portfolio to remain invested while the borrowed capital is used for a different opportunity. Now, this is extremely powerful. However, the risk is also very significant. The investments that you have securing the credit line, they can decline in value. And if the portfolio falls below a certain required collateral level, the borrower may be required to deposit additional assets, meaning you have to put more money in, or you have to repay part of the balance, or you risk having your investment sold by the lender. That forced sale could happen at the worst possible time. Like, imagine that the market is declining very sharply and your portfolio already lost a substantial amount of value. That lender will then require you to provide additional collateral, and if you don't have enough cash or enough eligible assets available, they would liquidate part of your portfolio. You could lose investments at depressed prices, create additional tax consequences, and still experience a loss on whatever opportunity that you use the borrowed money for. Now, this is a strategy that I have considered through my E-Trade account and Fidelity. So based on the terms that were available to me, I was able to access a credit line up to 75% of my eligible portfolio without even having a personal credit check. If you're interested in how I did this, let me know in the comments below. I'd be more than happy to make that video on the SBLOC. However, borrowing limits, collateral requirements, interest rates, and approval standards will vary depending on the lender and the assets inside of the account. This type of credit line is generally suited for borrowers who have substantial investments in assets, they have stable income, additional liquidity, and a clear understanding of market risk. Another important limitation is that the borrowed money may not be used to purchase or trade additional securities, so you can't use it to actually buy more stock. You need to understand exactly what the lender allows before using these funds. Still, the appeal of this account is very easy for anyone to understand. Your money remains invested while you access capital for a business. business, a real estate purchase, or some other qualified opportunity. I also discussed this strategy in my video titled The Financial Secret That Banks Fear That You'll Learn: Buy, Borrow, Die. In that video, I break down how wealthy investors will use SB locks and portfolio lines of credit to access capital. They also will continue growing their assets and virtually pay zero taxes. I'm going to link that video right here in case you want to watch that. The fourth account is an SBA business loan. Now, I recently did a video explaining how SBA loans work and how even a newer business can still qualify for funding. I'm going to link that video here because it provides a much deeper breakdown of the application process. And one of the greatest advantages of SBA-backed financing is the potential for longer repayment terms compared to many other types of business loans. A longer repayment period can reduce the required monthly payment. You can also make larger investments more manageable from a cash flow perspective. For example, imagine that you want to purchase a piece of equipment that could allow your company to double its production. Now, that equipment might cost you $100,000. Financing that purchase with a short-term loan can carry extremely high monthly payments, and that could place pressure on your business. An SBA-backed loan may allow you to spread that cost over a longer period of time to better match the useful life of that equipment and the income that you expect to produce. The same principle can apply when expanding your operations or acquiring commercial real estate or making some other significant investment in your company. There's also a lot of misinformation surrounding documentation required to receive SBA financing. While yes, traditionally the lender will review your personal credit, your business credit, your tax returns, bank statements, existing debt obligations, your business financials, and other supporting documentation, the process itself can be more manageable when you understand exactly what the lender is looking for and you prepare for everything in advance. I've personally been approved for several SBA loans, so I know from experience. Again, I recommend watching my SBA loan video for a more detailed explanation of how to position yourself and your business for these approvals. An SBA loan can help you make a significant move that would be difficult to fund using personal savings alone. However, the loan only becomes a wealth building tool when you use that for business or an asset that will produce more income. The goal isn't for you to celebrate just getting approved for something. The goal is to actually get approved and to purchase something that will continue generating income long after that loan has been repaid. The fifth account is a traditional business line of credit. Now, a business line of credit gives a company ongoing access to capital without requiring the owner to apply for a new loan every time money is needed. That flexibility can be extremely valuable because business opportunities and any expenses that you don't expect don't arrive at the most convenient times. Your company may need to purchase inventory before receiving a payment from a customer, or covering payroll during a slower month, to repair essential equipment, or to act fast on some opportunity that could generate additional revenue. A business line of credit can help you bridge the gap between temporary expenses and incoming cash flow. And unlike a traditional term loan where you receive the entire loan amount up front, a line of credit will allow you to borrow only what you need. So you could actually have a business line of credit where you can access $100,000, but you may only need $20,000. In most cases, your interest charges are only based on the amount that you borrow, and that will be subject to the lender's rates, any fees, or any accounting terms. As you repay the balance, that portion of the credit line will typically become available to use again. Now, this revolving structure allows your account to remain useful for future expenses and opportunities without requiring a completely new application every single time you need it. I've covered business lines of credit in several videos, and I've also been approved for each of these business lines of credit. Check out my business credit playlist down in the description. You'll find a detailed breakdown on how to qualify for Wells Fargo, American Express, Blue Vine, First Citizens Bank, US Bank, Associated Bank, and a whole lot more. This sixth account may be the most powerful one in this entire video, and that is a business acquisition loan. Now, most entrepreneurs assume that the only way to become a business owner is to start a company from zero. But starting a company from scratch is not your only option. You can also purchase an existing business. A business acquisition loan can help finance the purchase of a company that may already have customers, revenue, employees, equipment, vendor relationships, intellectual property, and established operating procedures. Instead of spending several years trying to create cash flow from nothing, you may be able to acquire cash flow that already exists. So imagine a business that's generating $500,000 in annual revenue and produces $150,000 in owner earnings. The current owner is ready to retire and wants to sell the company. Now, you may not have enough cash to pay the full purchase price up front, but a lender may be willing to finance a portion of the transaction if the business has strong financial performance and you meet the qualification requirements. You may be required to provide a down payment, give a personal guarantee, demonstrate relevant management experience, and show that the company's cash flow can comfortably support the new debt. When the transaction is structured responsibly, the acquired business may generate enough income to make the loan payments to pay you a salary, covering its operating expenses, and still produce a profit. Once the loan has been repaid, you own an income-producing asset that may continue generating cash flow and could potentially be sold again in the future. This is one of the ways that credit can help compress time. However, purchasing an existing business is not automatically safer than starting one yourself. The financial statements could be misleading and the company's revenue may depend too heavily on one customer. The current owner may personally control important relationships that do not transfer after the sale. This is why serious due diligence is essential. You should review the company's tax returns, the profit and loss statements, the balance sheets, the bank statements, the payroll records, customer concentration, contracts, leases, licenses, employee information, debt obligations, equipment condition, legal issues, online reviews, and the owner's reason for selling. All of these things will come into play. You should also determine how much cash flow will remain after paying operating expenses, taxes, your salary, and the acquisition loan. If there's not enough margin left after all the company's obligations are paid, that opportunity may not be nearly as attractive as it initially appears. A business acquisition loan can be life-changing because it allows you to purchase an income-producing asset instead of just simply financing an expense. But the goal is not just to buy a business. The goal is to acquire a strong business at a reasonable price, to structure the financing responsibly, and to make sure that the company will continue producing income after your transaction is complete. I have an entire video explaining how to purchase a business using a business acquisition loan. I recommend watching that for a detailed breakdown. I'm going to link that video right here. Now, if I hit my limit on video links, you may have to go to my YouTube channel and search for it, but that video will come up. I want to thank you guys so much for watching this video. Now, these 6 accounts are very different, but they all follow the same basic principle. The money that you borrow should be used to produce more value than it costs. An approval is not profit. The credit account doesn't become an asset simply because the funds appear into your bank account. The moment you borrow the money, you have cash on one side of your financial statement and a liability on the other. Your decisions after the approval will determine whether or not the debt creates wealth or destroys it. Start by strengthening your personal credit, then improve your income and learn how the business operates and develop the discipline required to manage money responsibly. Then, as your financial position continues to improve, you can begin evaluating which one of these tools actually will match your goals. Borrow when the opportunity is clear, the numbers make sense, and the repayment plan is realistic, and the potential rewards actually justify the risk. If this video provided you with value and gave you some insights on some accounts that you never really thought about, then please like the video, subscribe to the channel, and share this content with someone who you think might need it. If you guys have any questions about any one of these loans, drop that in the comments below. I have been approved for each one of these with the exception of the acquisition loan and the HELOC loan. Eventually I will get a HELOC loan, but then that'll happen when I have my home and equity in it. And the acquisition loan, I can pretty much get that with an SBA loan or some other products, but anything else I have been approved for, and I would be more than happy to answer any of those questions for you. And as always, thank you so much for watching this video, and you have a wonderful day.